I'm Matt Bichard with REIT.com here in Chicago for REITWeek 2013. Joining me for this CEO Spotlight is Bruce Duncan, President and CEO of First Industrial Realty Trust. Bruce, thanks for joining us.
Matt, thanks for having me.
Now, the economy seems to be continuing at a steady, if not spectacular, recovery, and how is that translating to fundamentals in your sector?
Again, it is a direct correlation. If you look at it, as the economy improves, you need industrial facilities to be able to distribute, assemble, more goods. And so our business is doing pretty well. If you look at it, for the last 11 quarters, there's been an absorption in the industrial market. Personally, at First Industrial, since the first quarter of 2010, we gained 820 basis points in occupancy. So again, the trend is good, we're picking up, and I think we all feel pretty good. But again, it's dependent on the economy to continue to grow.
And in your first quarter earnings calls, you said that pricing for quality acquisitions was starting to become inflated. Does that put more of a pressure for your company on your development efforts?
Well, I would say here, it's sort of a high-class problem. We've been disappointed in not being able to buy properties at prices we thought made sense. And because there's so much demand and capital coming into the marketplace. And in the good markets, your cap rates are in the mid 5% or low 5% to buy. So we are doing more in the development area, and again, our focus, we've got 67 million square feet of industrial, so this pricing is good for us, but we are doing more in industrial development. If you look at what we've done, we did a 692,000 square foot development in the Inland Empire in Southern California last year and leased it up. We just finished a 300,000 square foot development in Chino, which is the Inland Empire West, and we just leased that up. We've got a 492,000 square foot development in the infill location in LA that will be finished in the third quarter, and we've got to get that leased. And we've got a 708,000 square foot development in York, Pennsylvania that we finish at the end of the year. We need to get leased. But that's good. We feel good about our development. We're getting 100 to 200 basis points yield ahead of what we think we can buy for, and it's improving the quality of the portfolio. So I think we feel very good about that.
And as part of your development efforts, you also purchased land for future development purposes. Now, are there areas that you're kind of looking to target now, kind of store it away because you think they're going to be good opportunities?
Yes, we've got a great pipeline in terms of for development going forward. We're going to start a 555,000 square foot development in the Inland Empire, sort of adjacent to that 692,000 square foot we did last year. We'll start that in the third quarter. We just assembled by buying from like 11 different sellers, a site that can accommodate about 1,370,000 square feet of development. That will probably start in the third or fourth quarter of next year if everything goes right. And then we have a site in Houston for 350,000 square feet that will start next year. And we've got sites in Pennsylvania that can accommodate a couple sites that can do 600,000 feet each. We've got a site in Dallas. We've got a site in Nashville, so we've got some land in California. So again, the nice thing is we've got built-in internal growth, and we think development makes a lot of sense for us because we're getting a high risk-adjusted return, and we're getting high-quality assets in the markets we want. So we're very optimistic about that. But again, the onus is on us to deliver, to build them on time, on budget, and get them leased ahead of pro forma.
Bruce, thank you so much for joining us today.
Thank you for having us.
For more on this and other REIT news and analysis, be sure to visit REIT.com.